All right, I appreciate everybody being able to attend the class. So we're going to be going over the Ichimoku Cloud technical indicator today. We're going to be going over, we're going to be answering the Q&A at the end. So we're going to begin with the indicator, how it works and everything, and then we can go over analysis. And then in the Q&A, you guys can show me stocks that you guys will trade, and I can go ahead and chart them out and show you what I see with them. So the Ichimoku Cloud indicator, it's a effective dynamic trend following indicator that was developed on for over 30 years before being released to the public in 1969. So it was made by a Japanese journalist named Koichi Hoshida. He wrote 7 books in total about this technical indicator and his trading methodology. And back then, those 7 books were like decade-long bestsellers. So it was a really, really popular technical indicator at the time. So he was a Japanese journalist that charted rice futures at the time. So the technical indicator, back then, they didn't have calculators or computers for that matter. So they had a bunch of interns to do the calculations via paper to draw out the lines and draw out these charts essentially. So now that we have the benefit of using, computers that can just chart it out onto your whatever you're looking at really, really quick, it makes it much easier. So the technical indicator, it's created to show you the trend of the stock at a glance. So the Japanese name is Ichimoku Kinko, but the name we call it in English is just Ichimoku Cloud. So at a glance, it probably looks a little bit complicated because there's a lot of lines and you don't know what all of them are there for and how to read this chart exactly, but it's actually really, really simple once you learn how to use it. So we've got 5 different lines. The first line we have is going to be this Tenkan-sen conversion line, which is going to be this blue line here. Tenkan-sen is the Japanese name, conversion line is the English name. So it's going to be that blue line. The next line we have is the Kijun-sen baseline. So Kijun-sen is the Japanese name, baseline, what we call it in English. It's going to be this purple line here. And then next up, we have the Senku span A, which is going to be this yellow line on the top of this Kumo, this cloud portion. And the next line we have is the Senku span B. So English is span B, span A. Japanese is Senku span. So make it easier, we'll just say span A, span B. So span B is going to be this white line at the bottom of the Kumo. So these 2 lines, they form this cloud portion of the Ichimoku Cloud indicator. And we'll get into detail on how these exactly work with the technical indicator. And the last line we have is the Chiku span lagging line. It's going to be this red line up here. And it probably looks a little bit confusing because we call it the lagging line and it's nowhere near what the current present price action is. It's like pushed back 26 periods. And we'll get into why it's pushed back 26 periods and what its relevance is with the rest of the indicator. So these 5 lines, they work as an indicator set to help you determine when to buy, when to get out, when to take no action, what the current trend of the stock is, where the levels of support and resistance for this stock currently are at. So we're going to go with the first line first. It's going to be the Tenkan-sen conversion line. So the Tenkan-sen conversion line, which is going to be this blue line on the chart, is a moving average that's created by adding the highest and lowest prices of a stock over the last 9 periods. So last 9 candles on your chart essentially. So the last 9 periods as in like last 9 however many candle time frames you're looking at. So for the last 9 candles, we're going to be taking the highest and lowest prices of each of these candles, adding them together and then dividing by 2 and then plotting this line onto the chart. So it's very, very similar to a simple moving average or an exponential moving average in terms of calculation, but it's very different in the way it gets its calculation. So instead of a Western moving average where we only take the closing price of each candlestick, we're actually accounting for the full range of price action each candlestick has during that 9-period time frame and adding those together, the highest lowest price of each of those together, and then dividing by 2. So that's a midpoint calculation opposed to our Western calculations who are just simple closing price on each candle calculations. So it's a midpoint calculation. We use more data points for this particular moving average line. So this Tenkan-sen conversion line, this blue line here, is going to be the closest line to your share price usually at all times when you're using the Ichimoku Cloud indicator. And this line will act as your short-term support or resistance. So in short, if your share price is above this blue conversion line, then this conversion line will act as support. But if your share price is below it, like over here, for example, during this time frame when your share price is below the blue line, the conversion line, Tenkan-sen line, is going to be acting as resistance, short-term resistance. So same case over here. Share price above blue conversion line, that means that this blue conversion line is acting as support. And when it's below it, like back here, that means that this Tenkan-sen conversion line is acting as resistance for this time frame. So the next line we're going to be going over is going to be the Kijun-sen baseline. So Kijun-sen baseline is going to be your purple line here. This one is also a moving average. It's using a same midpoint calculation as the Tenkan-sen conversion line. However, it's using a longer time frame. So instead of the last 9 candles, we're taking the last 26 candles, taking the highest and lowest prices of the last 26 candles on your stock, adding them together, and then dividing them by 2. And then that's how you get this Kijun-sen baseline put onto the chart. So this line acts as a midpoint support and resistance. A midterm support and resistance. So it's more significant than your Tenkan-sen conversion line, the blue line. And it's going to be a little bit further away compared to your share price. So as you can see, it's further away from the share price pretty often compared to the conversion line, which sticks closer to the share price. So as the stock is going up, it's trending up. You can see that conversion line is sticking with the share price closer than the Kijun-sen baseline. Kijun-sen baseline is acting as a significant level of support during this time frame. So it's the same concept. If your candlesticks are above the Kijun-sen baseline, then the Kijun-sen baseline will be acting as support. And if your share price is below it, like during this time frame down here, where you see the candlesticks are below the purple line, that means the Kijun-sen baseline is going to be acting as a resistance level. So if your Kijun-sen baseline is, if your share price breaks below the Kijun-sen baseline, that's an indication that there's a higher chance that the overall trend is going to be shifting to the bears. But if the share price is above the Kijun-sen baseline, it's also an indication that there's a higher chance that the overall trend is going to be bullish for the stock. So the next 2 lines we're going to be going over is going to be the Senkou Span A, Senkou Span B. So the Senkou Span A and Senkou Span B lines, they work together to form the Kumo portion of the cloud, which is going to be this green fill-in and this red fill-in area of the cloud. So the Senkou Span A line, which is going to be the top line of the cloud when the cloud is green, and it's going to be the bottom line of the cloud when the cloud is red. So whether or not it's on the top or bottom has no real significance. That only affects the color of the cloud. So the Senkou Span A line, which is going to be this top line here, this line is a combination of the Tenkan-sen conversion line and the Kijun-sen baselines calculations. So you're adding the conversion line calculation with the baseline calculation together, and then you're plotting it onto the chart. Then you're pushing this line 26 periods into the future. Now that might be a little bit confusing to why you're doing that, but the reason that they're pushing it 26 periods into the future is to try to chart out where it believes future significant levels of support or resistance are going to be, like further on into the future. And it's actually surprisingly pretty accurate across different time frames. So that's how you get the Senkou Span A line. It's going to be even more significant of a line than the Tenkan-sen conversion line and the Kijun-sen baseline. So for the next line, the Senkou Span B line, the Span B line is going to be this white line. It's going to be the line on the bottom when the cloud is green. And it's going to be the line on top when the cloud is red. So to get the Senkou Span B line, it's a very, very simple calculations. It's essentially a 52-day moving average or a 52 candle moving average. So you're taking the highest and lowest prices of the last 52 candles on your chart, adding them together, and then dividing them by 2, sticking onto the chart, and then pushing this line 26 periods into the future. So it's essentially 52-day moving average, but it's a midpoint calculation. So you're not taking the closing price of each candle, you're taking the highest and lowest price of each of those 52 candles. So when you get the cloud portion, the green portion of the cloud, or the red portion of the cloud, if your cloud is green towards the very, very right, that tends to be an indication that it believes the overall trend of the stock is going to be bullish during the time frame it's green. And if your cloud is red, that means it believes the overall trend of the stock is going to be bearish during the time frame that the cloud is red. So an easy way to look at this is if you have your share price above the cloud, whether it's green or red, that means the overall trend of the stock is going to be bullish. But if your share price is beneath the cloud, like down here, that means the overall trend of your stock is bearish for that time frame. Now, whether the cloud is red or green doesn't really matter to show you like what the current trend is. What's more important is you seeing where the candlesticks are in relation to the cloud. So the thickness of the cloud also plays a factor into this. So you'll often see the Span A, Span B lines being used as support and resistance for your stock. they're going to be like more significant levels of support and resistance. So if your share price is above the span A and span B line, the distance between the candlesticks and the top line of the cloud is going to be significant, or your cloud in general. So if your share price is very, very far away from your cloud, that means that the overall trend is going to be stronger in whatever direction is going on. So if your share price is bullish, candlesticks above the cloud, but is really far away, that means the current trend is probably really, really strong. It's going really, really strongly up. But if your share price is beneath the cloud and it's really, really far away from your cloud, that means the overall trend for the stock going to the downside is probably really, really strong compared to if it was share price was really, really close to the cloud and bouncing off these lines. So easy way to look at it is share price above the cloud, overall trend bullish. Share price beneath the cloud, overall trend bearish. If your share price is inside the cloud, like over here, that means it's in a consolidation phase. So the trend isn't definite. It's not bullish or bearish. It's currently figuring out which direction it actually wants to go. So in this time frame, you can see that the candlesticks are currently inside the cloud, and it's having difficulty figuring out which direction it wants to go. So it did break above the cloud for a little bit, but then after a couple of days, it went straight back into the cloud. So next up, we have the thickness of the cloud itself. So if you have a very, very thick green cloud, that means the share price is going to have a very easy time breaking into either the top line or the bottom line of the cloud. So the span A line or the span B line of the cloud. But it's going to have a harder time reversing trend completely, because remember, the share price has to be below, or has to break below the cloud or above the cloud in order to change its trend. So in a very thick cloud, the share price is going to be able to break below one line of the cloud, but it's going to have a tough time breaking through the whole cloud completely. It'll probably take a way longer time for it to break through the cloud completely. In a very, very thin cloud, however, most of the strength of the support or resistance on the span A and span B line is going to be focused on the lines themselves instead of the fill-in color portion of the cloud. So in a thin cloud, if the share price manages to break through one line, that means it's going to have a very easy time breaking through the next line and reversing the trend of the stock completely. So in a very thin cloud, if one line's broken, the next line is likely to break in very, very short fashion. But in the very thick cloud, if one line breaks, the whole trend may not shift very quickly. In fact, it could bounce off the bottom line of the cloud and go straight back up and break back above the cloud again. So something you need to take into account is how thick the cloud is and how thin the cloud is wherever you're looking at it. So in this area right here, you can see that the red cloud is extremely thin. So if the share price did come close to testing any of these lines, most of that support or resistance strength is going to be on the lines of the Ichimoku Cloud indicator. So the span A, span B are going to be the most significant lines of support and resistance in a thin cloud. But in a thick cloud, it's going to be spread out throughout the whole color fill-in area. So next up, we're going to be looking at the lagging line. So the lagging line, very, very simple line, though it's kind of confusing in its use. So essentially, lagging line, it's basically the closing price of your present price action. Pull it out onto the chart, and then pushed 26 periods back into the past. So what's the point of doing that? Apologies. It says compared to the stock of the last 16 candles, but this is supposed to be 26, so ignore that. But essentially, this line is a shadow of your current price action compared to your past price action. So the point of this is to show you if the endpoint, wherever the lagging line is ending, 26 periods back is above your previous price action, which is all the way down here, the candlesticks are down here, 26 periods back, and the current price action is up here, and the lagging line being pushed back 26 periods is up here. If your endpoint is above previous price action, that shows that the current momentum of the stock is more bullish than previous price action. So that means this bull trend is likely to continue going. So it's very, very simple. So back here, for example, this candlestick here is the endpoint for the price action over here. So this is where the lagging line was when this candle was formed. And you can see that this lagging line's endpoint is below previous price action, showing that the current bearish trend is stronger than the previous bearish trend that the stock had in price action in the past. So how do you add those two together? So we use this in conjunction with something we call the TK crossovers, which is the Tenkan-sen conversion line and the Kijun-sen baseline. So at a glance, we should be able to tell what the current price action of the stock is, where levels of support and resistance are on your chart. So if you look at the stock here, you have share price above cloud, so overall trend is likely to be bullish. You've got share price above the conversion line for quite a long period. It's also above the baseline, so overall trend is still bullish. And your lagging line up here compared to current price action is still above previous price action, so this bull trend is likely to continue. And you've got a formation of the green cloud still going up into the future, so that's showing that it believes that significant levels of support are still going to be going further up later into the future. And price action is probably going to be more bullish in the future as well, continuing to be bullish in the future. So TK crossovers is how we make trade entry decisions and trade exit decisions. So TK crossovers with the Ichimoku Cloud indicator is essentially the Tenkan-sen conversion line and the Kijun-sen baseline crossing over each other. So Tenkan-sen conversion line crossing above or below the Kijun-sen baseline creates a TK crossover. So in a TK crossover to the upside, that means that the overall trend of the stock is likely to have shifted to the bulls. So when you have a TK crossover to the upside, like right here, where you have the conversion line, the Tenkan-sen conversion line crossing above the Kijun-sen baseline, blue line crossing above the purple line, that means that the Ichimoku Cloud indicator believes that an overall trend shift has occurred and the stock is currently on a bullish run. So in order to confirm if this TK crossover to the upside is correct, it's valid, it's not a fake out, there's a couple of factors we need to look at. So in a TK crossover to the upside, the factors you want to see is current candlestick price action above the conversion line. So the candlestick has to already be able to be above the conversion line. And you want previous price action compared to current price action. So to do that, you'd be looking at this candlestick here, your entry candlestick, and then you'd be looking at 26 periods back where the lagging line was ending. So lagging line endpoint was up here 26 periods back. And you can see the endpoint is above the previous candlesticks, showing that the current bullish momentum here is stronger than the previous bullish momentum in the past, showing that this TK crossover to the upside is likely to play out. So what you would do is you would buy here, you would ride the stock up, and when this stock share price breaks beneath the conversion line and closes below the conversion line, so when the candlestick closes and switches to the next candlestick, if it closes beneath the conversion line, you would take that as an exit. So you would take profit there and you would re-enter if the share price breaks back above the conversion line. As long as the conversion line is above the Kijun-sen baseline and a TK cross up is still in effect. So buy here, exit here on a break of conversion line, taking profit, and then re-enter when the share price breaks above the conversion line again. So you get back in here, you get out here when it breaks below the conversion line again, Tenkan-sen conversion line, and then you get back in when it breaks above the Tenkan-sen conversion line, and then you get out when it breaks below again, and then re-enter when it gets back in. And now you're going up, you're still in the trade because the share price is still up. So you can use the Tenkan-sen conversion line as your profit taking and stop loss point. It's a dynamic line, so it'll be moving up to confirm that will guarantee you'll take profit if it breaks beneath it. So share price going up, break below the conversion line, get out, break back above the conversion line, get back in. You can use this Kijun-sen baseline, the purple line over here, as a higher risk tolerance stop loss or profit taking point. So if you don't want to be getting in, getting out, getting out, getting in, getting out, getting in multiple times on this blue conversion line, you can use the Kijun-sen baseline, the purple line here, as your stop loss or profit taking point instead. But your profit taking point is likely not going to be as high as a conversion line, the Tenkan-sen conversion line profit taking point, if you're going with a Kijun-sen baseline. The Kijun-sen baseline is just if you have a high risk tolerance, you're okay with not taking the highest amount of profit on a particular trade. So there are traditional guidelines as well with the TK crossovers that you need to take into account. the traditional guidelines have their use cases, but in modern use cases, we don't really put that much weight on them, so we kind of ignore them. So in the traditional guidelines for TK crossovers is if you have a TK crossover happen and it's above the cloud, so let's say this TK crossover to the upside happened above the cloud instead, that's going to be a strong signal. So it's going to be a strong crossover. It's a higher chance of it playing out. So by traditional guidelines, you would take the trade. If your TK cross up that's below the cloud, like down here, for example, in this example where it actually ran up, this is seen as a weak crossover to the upside. And generally, you wouldn't take this trade if a TK crossover to the upside happened beneath the cloud, going by traditional guidelines. And if you have a TK cross up happen inside the cloud, or let's say this TK crossover is happening inside of the cloud somewhere, like right here, for example, that's a neutral strength guideline, so neutral signal. So it's kind of a toss-up, 50-50 if you would take the trade or not in traditional guidelines. And it's the same concept with TK crossovers to the downside. So if you have a TK crossover to the downside, which we'll have more examples of that in a little bit, but when you have a TK crossover to the downside happen beneath the cloud, that means it's going to be a strong signal for a cross down for trend shift to the downside. And if you have a TK crossover inside the cloud, it's going to be a neutral trend shift. So the neutral signal, it's a 50-50 toss-up if it's going to be going up or down. If a TK crossover happened above the cloud to the downside, then it's going to be a weak signal. So it's likely to not play out. So generally, you wouldn't take those trades at all. But those are just traditional guidelines, and we don't really use the traditional guidelines anymore. So if you have a TK crossover happen to the upside and it's below the cloud, and all these factors line up with share price above conversion line, lagging line endpoint above previous price action 26 periods back, then you can take this trade, and it will generally have a higher chance of actually playing out. So the traditional guidelines, just good to know, but not important and actually required for current modern use cases with the Ichimoku Cloud Indicator. So here we have an example of a TK crossover to the downside. So we have a TK crossover to the downside with the conversion line crossing beneath the Kijun-sen baseline here. And if you look 26 periods back, you can see that lagging line is endpoint was over here, and it is below the previous price action. So the red line, which is lagging line, where it stopped when you were at this candle, it was already beneath the previous price action, which indicates that this TK crossover to the downside is likely to play out. So it's not going to be a fake out signal. You've got a red candle here. So you would get in on this red candle for short, ride it all the way down. And over here, when this green candle breaks above the conversion line, you would go ahead and take profit. So you would exit. And if you had higher risk tolerance, then you would get out here on the break of the Kijun-sen baseline. Now, remember, as long as the TK crossover either to the upside or the downside is still in effect, as in the conversion line is still beneath the Kijun-sen baseline in this example with the TK crossover to the downside, and your share price breaks beneath the conversion line, which is the Tekkensen, the blue line here, you can still get back in. So in this case, it broke beneath the conversion line again, and the TK cross to the downside is still in effect, so you can make a re-entry for a short position here, ride that price all the way down, and then when it breaks above that conversion line again, you can go ahead and take your exit, take profit. And then when it breaks above that Kijun-sen baseline, you can go ahead and take profit there too, as long as if you have high risk tolerance. So over here we have an example on SPY. So we have a TK crossover to the upside here. This is on a 5-minute time frame intraday. So 5-minute intraday. I don't remember which day this was. This was on the 4/11/2024, so this year. So TK cross up, 5-minute time frame. Candlesticks are already above your conversion line, which is good. But if you look at this red candle here and you trace it back 26 periods into the past, you can see that lagging line endpoint is still beneath previous price action. So that's showing that this bullish momentum here is not that strong compared to previous price action. So previous price action was still above current price action. So you would not be getting in on this red candle. Instead, you would be getting in on this green candle instead. So your entry point is going to be on this candle, because if you look back 26 periods, this is where the lagging line endpoint was at the time where it ended. And you can see that this lagging line endpoint is above previous candlesticks, showing that current price action is stronger than previous price action now. So it's safe to make your entry point here. And you're getting in here a little bit late, but it's still valid because the TK crossover is still in effect. So your conversion line is still above the baseline, and in fact, it's getting wider as it's going. So this next slide here, we can see how that played out. So your lagging line endpoint was over here when you got in for your entry point on this green candle here, and your TK crossover was over here. So all the factors lined up after a couple of candles after the TK crossover. So since the TK crossover is still in effect, you get on this candle, ride the share price on the conversion line, and over here you can see that the green candle over here did open beneath the conversion line, but as long as it didn't close beneath the conversion line, you're fine. You don't have to get out of the position. So you're staying in the trade, you're riding it up, and over here on this red candle, when it finally broke beneath the conversion line, you can go ahead and take profit. So exit here on break of the conversion line, and it's closed beneath the conversion line. So you take profit there. And there's a couple of instances where it breaks above and beneath the conversion line a couple of times towards the end of the day here. And if you did trade these, you would just be breaking even or taking a very minor loss. So this is up to your discretion if you want to make these later on trades during the day. But essentially, this is just a really good example of how this would work out. So this TK cross up, get in, get out, you're done. You're done for the day. And if you had high risk tolerance, you'd be getting out over here towards the very, very end of the day when it finally broke beneath the Kijun-sen baseline, the purple line here. So another example here. We don't have a TK crossover on the chart itself, but the TK crossover happened in pre-market hours. So the market opened with the conversion line already above the Kijun-sen baseline on this 5-minute chart for Apple. So since it's still in effect, that means that as long as your share price is closing above the conversion line, the Tekkensen conversion line, you can get in. So you'd be making an entry on this green candle, you'd be getting stopped out on this red candle, break beneath the conversion line at break even, getting right back in when it breaks above that conversion line again, getting out for a little bit of profit, getting back in, getting out over here again for profit, getting back in when it breaks above it, riding it all the way up before getting out here for profit, and then getting back in again, and then getting out for profit when the market closed. It didn't even break beneath the conversion line at the close of the market, but if it's a day trade, you want to get out before the day ends. So take profit there. Over here we have another example. So we have messy market price action. So you can see that you've got candlesticks going up and down, up and down, up and down. And you've got TK lines already across to the downside, but your share price is breaking above, breaking below. So if you did get in, you would have gotten stopped out right there. So there's no trades to take right here at this time frame. Now, if you look over here, there's a TK cross up with the conversion line crossed above the Kijun-sen baseline. And this is a bad signal because your candlestick is not already above the conversion line when this TK crossover to the upside happened. On top of that, if you look back 26 periods back on this red candle when this TK crossed up happened, your share price was beneath. Share price is beneath previous price action. So this is definitely a fake out, not a very good crossover to the upside, not a signal you'd want to take. So over here, shortly after, you have a TK crossover to the downside. So the blue conversion line crossed beneath the baseline here. And if you look at this one, candlesticks already beneath the conversion line, which is good. And if you look back 26 periods back, the endpoint of the lagging line is right here, which is beneath previous price action, showing that the current downwards momentum here is actually stronger than previous price action 26 periods back, showing that this is a valid TK cross to the downside. So what you would do is you would start a short position on this red candle here. Then for the next slide, we've got a continuation. So TK cross down happened here. You got in on this candle. You rode it all the way down. And when you have a green candle that broke above that conversion line, you take your profit. So when it broke above the conversion line resistance, since the share price is beneath conversion line is acting as resistance, you would take profit there. And if you had high risk tolerance and you were using this Kijun-sen baseline as your profit taking zone, you would take your profit right there when it broke above that Kijun-sen baseline. So next up, you have a TK cross up happen shortly after. And your share price is above that TK cross up line, the conversion line there. However, if you look 26 periods back, the lagging line endpoint was below previous price action, showing that the current bullish momentum here isn't stronger than whatever price action we had 26 periods back. So it's not likely to play out. So you wouldn't make an entry here. And if you did make an entry on that candle, you would have gotten stopped out for a loss shortly after anyway. So that's a good example of a fake out signal by looking at the lagging line endpoint compared to current price action with previous price action. So we've got candles moving down. You've got a TK crossover to the downside. But these are all signals that you wouldn't take. They're all fake out signals because the lagging line is not in the correct position you want it to be in when these crossovers happen. So crossover to the downside happen. If you look 26 periods back, the candlestick is still inside previous candles, technically beneath the close of that candle as well. So these TK crossovers to the downside and to the upside over here are non-signals that you wouldn't take. So that's how you would be using this technical indicator in order to find these trades during an intraday chart. So we've got another example here. So this is on 3M, MMM. You've got the lagging line endpoint over here. You've got a TK cross down. So TK cross down here, your short entry would be over here because this is when the TK cross down separation happened. So you can get in here and you compare the lagging line endpoint to previous price action. So lagging line endpoint was right here when this TK crossover to the downside happened, and it is beneath previous price action, showing that the current bearish price action is stronger than previous price action. So get it on this candle, ride it down, and when your share price breaks above that blue conversion line right there, you would take profit. Share price did break beneath conversion line again, broke back above conversion line. And these are all potential re-entries and exits here when it breaks beneath conversion line again and breaks above the conversion line. However, they're basically break even. So during this time frame, you would have made no money. You would have basically lost no money as well. So the dynamic effect of the Kijun-sen baseline and the Tenkan-sen conversion line helps you basically control the amount of losses you could potentially take, or basically break even in this time frame. So you've got a TK cross up afterwards, and you've got a entry point over here because if you look at this TK cross up, this candlestick is right there. If you move this 26 periods back, you can see that the endpoint, which would be right here, is still beneath previous price action, so you wouldn't be getting on this candle. However, on this candle, the endpoint of the lagging line is above previous price action, above previous candlesticks. So you would be making an entry for a long position on this candlestick here. You'd write it up, exit, re-entry, write it up on the conversion line support. Red candle there, break beneath the conversion line, so take your exit there. And that's basically this trade as well. So there's multiple trades on this one. You've got downtrend trade, you've got uptrend trade. It's on daily time frame. And you can see this gap, these gapped candles here, down here, and then gapped up there. This is all news based. So they had an earnings for this gap down to happen. They had other news for this gap up to happen. So that's one of the weaknesses. So like no real technical, and not a lot of technical indicators can chart for news-based fundamental effects that will move the stock. So like this fundamental stuff. So yeah, that's essentially how to use the Ichimoku Cloud.